Hi, good afternoon, everyone. Hello.
Good afternoon.
Yeah, good afternoon, Antonio.
Hello.
Good afternoon, Khalid. Good afternoon, Aura. Good afternoon, Khalid. How's everybody today? Hmm? I see we have seven people. We have seven people in the collaborate right now, and but um, let's see how many people are in the discussion board. I see seven people. So yeah, the numbers match, right? All those seven in the collaborate session have already signed in also in the discussion board. And I've been telling you that's important. That's what's important, right? Um, that's the proof, physical proof of your attendance. Now, um, so I would like to call your attention to uh, I would like to call your attention to the quiz one announcement, right? Quiz one. You see, the um, the quiz one has been assigned already, right? And it's gonna be available from this Friday, right? You must have got this by email already, or if you haven't yet, please check your email, or also you can check this instruction in the announcements. It's going to be from 12 a.m. Friday, right? This coming Friday, and until midnight Sunday. It's going to be available in the assignments folder. You won't be able to see it just yet because it's not visible. It's going to be visible um, from this Friday. Okay, so I'm going to exit preview and um, you see they are not visible there because they are already they are past. But this one is upcoming and it's not visible yet. And this will be the last Blackboard exam, right? This will be the last Blackboard exam because from midterm and on, it's going to be on Connect. Okay, you should all have your Connect access code. Um, and again, the Connect access code, you must have your own Connect access code that came with the book. But the temporary, I gave you a temporary super code, which is good until which will give you access to until uh, additional 2 weeks. And I talked about that last Wednesday. So I told you whoever the clock doesn't start with you. The clock starts ticking whenever the whoever the first person activates it, right? At least if there are more than if there are at least three people that have activated it, then the clock starts from the first three people, right? So we don't know when it was activated. It could have been activated last Wednesday or last Thursday, but the clock is ticking and it's only good until up to until 2 weeks from that day, and that's to give you access to it's just temporary access to connect so that you can do your um, topic 2, chapter 2, practice problems. And after that, you need really your own access code. Okay, so I can also, let me show you, let's see. So I'm sharing my screen now, right? Everyone can see my screen, right? Is that right? Let me just make sure nobody, yeah, I'm sharing my screen. So okay, good. I have 9 people, 8 people, right? So if you go to connect, I mean, this is not what it looks like to you because it's from my end. It will look different from your end. This is how it looks, if you go to my scores. At this point, only 3 chapter problems are visible, but it's because I just haven't made them visible. But this one is due October 8th. Actually, October 8th is the date when the first quiz starts. Okay, so you gotta get this. You gotta get this done. You gotta get this out of the way before the first quiz starts. And your first quiz is the first real exam. It's the first test that counts 20%. That counts 20% towards your grade. Okay. Everything else, other than quiz 1, midterm, quiz 2, and final, everything else is just your practice, right? And by doing, and think about it, also if they are practice, they don't count. They will count if you're at risk, right? But if you're not at risk, by doing the practice problems, you can do better in the exam, right? So the benefit is already, the benefit of doing this practice problems is already, express. In other words, it's explicit. It's contributing to your better results in the actual exams, right? So make sure, see, these things are not visible yet, but they are already built in, and I will make them visible as we go along. So you got to get started with you got to get this out of the way. And looks like only 2 people have done it so far. Only 2 people. This is out of 27. That means 27 people have see here. Well, there's got to be more people, right? See, these people, there's got to be more than 27, but because I have 4 sections of this class, 4 sections of this course, so 4 classes, and from each class, some classes have like more than 25 students on the roster, but 25 at maximum. Some classes have 20, some class has, less than 20, but at least, there should be something like 80 students on, and if you have, something like this, if it says license expired, what does that mean? You have used your temporary access, and those temporary 2 weeks trial 2 weeks have lapsed. Okay, and if your trial 2 weeks have lapsed, That's why you need to use this, a super code. The super code gives you, additional 2-week extension. Okay, additional 2-week extension. But as I said, the clock starts ticking when like first person has already activated. It doesn't start with you. It doesn't wait for you. It's not like when you start. The clock doesn't start when you start. The clock has already started when the first person has already activated it, right? So don't fall behind because you don't have 2 weeks. You may have only like 10 days left because first person has already activated, right? Or you may not even have not even 10 days. So please, get started ASAP. Now, so we are already into topic 2, and I've been telling you this this is the main lecture, and we go by the main lecture. According to the main lecture schedule, you are just 1 week away. I mean, not 1 week. So factoring part 4, only factoring 3, 4, 5 is left. Factoring 3, 4, 5, which will be assigned this Wednesday. So then, by this Wednesday, topic 2 is already over, right? Topic 2 is over. That's why you can take, quiz 1. So you must go by this, not by the collaborate. I've been telling you over and over, collaborate is nothing but a reflection and review, right? So if you have followed the lecture by if you have followed the class by the main lecture by this Wednesday, topic 2, you should, finish topic 2. And the ones that are no longer visible are already, more than 5 days old. And I told you where to find the lectures that are more than 5 days old. You can find them all on YouTube, right? I gave you my channel and playlist name. So without further ado, let's continue with from where we left off last Wednesday. So I said income statement and balance sheet serve two different purposes, right? The purpose of the income statement is to explain or describe the process that leads to profit or loss. You cannot always end up in profit, right? Sometimes you may end up in loss. And that's why income statement is also called profit and loss statement, P&L, or P/L, P&L statement. Now, if you think about it, profit and loss is the result. Profit and loss is the result of the income and expenses, right? If expenses are greater than income, then you end up in loss. If the income is greater than expenses, then you end up in profit. If they call it P&L statement, P&L, that's more, consequential, right? Calling it by the consequences. But calling it income and expenses statement, I told you the full name is income and expenses statement. Income statement is only a short for that. So calling it, income and expenses statement is more rather, more a deductive approach. In other words, this is where it is beginning, right? Profit and loss is the result. Income and expenses are, I cannot say that, I cannot call that cause, but they are the, you must have, that's the beginning, right? Now, one more thing. I probably forgot to mention this. The reason we are doing the this financial statements is because we started out with ROI, and basically the definition, the concept of ROI, and how it is related, related to the macroeconomy. In other words, what is the meaning of, what is the significance of ROI in terms of macroeconomy? And I told you, interest rate is the most bottom line. The interest rate is the bottom line return on investment, and based on the interest rate, the economy can be stimulated or economy can be cooled off, right? Depending on how the interest rate moves. And then suddenly, why financial statements? If you think about it, in topic 1, we looked at the ROI from macroeconomic perspective. Now in topic 2, we're looking at ROI from microeconomics perspective. In other words, from the company's perspective, right? From the business's perspective, how do we understand ROI and how do we compute ROI? So basically, the source of return is, basically, of course, the profit. And profit, we can find out about profit from the income statement. Last time I talked about 2 sources of income and 2 sources of expenses. Now there are 2 sources of income. One is the sales revenue, right? And I told you the sales revenue is the primary source of income. Why? Because every company has to sell something, right? Every company has to sell something for income, right? To get income, every company has to sell something, right? When you sell something, the money you receive or the payment you receive is called revenue, right? And we defined revenue mathematically. I mean, verbal definition of, because the verbal definition of revenue is always incomplete. It's open-ended, right? So we need a constant and closed-ended definition. And the closed-ended definition, compact and closed-ended, closed-ended, right? End is closed, right? Closed-ended definition is mathematical definition, and by mathematical definition, we defined it as price times quantity sold. Everyone remembers that? Revenue, or TR, that's the symbol for revenue, total revenue, right? Total revenue is price times quantity sold, right? So we talked about that last time. And then the secondary source of income, right? The other source of income is investment income. Now, investment income is a kind of passive income. It is a passive income, like investment income or rental income. They are all passive income, right? They are examples of passive income. It's called passive income because it's the result of It's not the result of operating activity. Passive income is not the result of operating activity, right? Every company is selling something. That's operating activity, right? So operating activity is literally activity. So the income resulting from operating activity is, you can say it's an active income, result of activity, right? So revenue is an earned income. Earned income resulting from activity, operating activity. Earned income is the primary source of income. Investment income, like dividends that you invested in stocks or bonds or in CDs in a bank, right? In the bank, they are passive income. A rental income is also passive income because you didn't, actively do anything. So if you can easily compare that with, I don't remember if I compared it to a personal income, case of personal income. I mean, think about it. If you work and you get your paycheck, that is your earned income or labor income, right? But it's like the sales revenue of a company. Why? Because your paycheck is the result of selling your labor, right? Oh, be it a physical labor or mental labor, right? That's your sales revenue. But you don't call that sales revenue because you're not a business, right? You are just, you're, an individual and you work and you earn your income. So it's called earned income, right? Uh, and also, as an individual, right? You have your investment, savings or investment. Whatever is in the savings is eventually invested, right? Because even if you don't directly invest it, the bank will invest it. So, but then the return on that investment, you get only a small fraction of it because the bank will keep most of it because bank doesn't pay more than 0.1% to you. As long as bank makes more than 0.1%, it's still, the bank will make more than 0.1%, of course, from on their investment. They want, but bank, you get only the interest, and you can claim the bank. You can claim that to the bank that at least 50% of that return is yours because there was no such agreement between you and the bank, right? You didn't take any risk. The bank took the risk. So the reward, the majority of the reward, the big chunk of the reward has to go to the risk taker, not to you. You didn't take any risk. So you get only 0.1%. So if you don't like that, then don't put your money in the bank, but take the risk, right? But there's no guarantee that you will have a positive return. You may have negative return, right? You may lose 100%. But that's the reward goes only to those who take the risk. Okay, and past couple of days, last week it was a really terrible market. Today, let's see. Let's see. Is this the today? Oh my God, I'm taking the beating. It's even gone. I mean, this week Monday has started with everything is in red. Monday. So last week I lost about 1.34%, and most likely there's no good news. I'll be losing to. God. But that's the risk you have to you should be willing to take. And in investing long term, right? In long term investment, that's what it takes. There are good times when the stock goes up. Senko had a data heavy week. Nasdaq. So it's October. That means what? October is the beginning of the fourth quarter, right? Beginning of the fourth quarter has begun, and the third quarter has ended. So that means in October, the third quarter results are coming in. Okay, so the first month of each quarter is called earnings season. Earnings season. Why is it called earnings season? Earnings report comes in. Earnings report earnings of the previous quarter. The third quarter results are coming in. Some companies may have made great profit, good earnings. Some companies may not. But this data comes in October. Also in third quarter started in July. The whole month of July, it was also earnings season. The second quarter results came in, right? So, and then when fourth quarter is over, then the fourth quarter results will come in January of 2022. Okay? So we are so the market is awaiting this earnings report from the third quarter, and some investors are taking a precaution, and they may some sell, some don't sell, some hold, but because of those sell, prices go down for no apparent reason. I mean, for no good reason, because we don't know the third quarter results yet, right? But it's not the it may not be the only reason, because is there any let's see, let me check Wall Street, if there's any news. Oh, because of the debt ceiling debate has not, yeah, it's not been closed. I mean, still there is no debt ceiling, but I know last week they extended the debt ceiling. But not to a limited. I mean, they extended, just to a limited extent. Nasdaq falls, of course. Nasdaq falls the most. And Evergrande kind of fizzled out. Why Evergrande is still, looming? Evergrande, it fizzled out, but it's still not out of the woods, right? It just hasn't defaulted yet. But most likely, it will default. Most likely, there's a bigger chance. There's more chance it's going to default than it's going to be a problem, right? But I want you to read. I want you to read that article after the class, because you have free access to Wall Street Journal and New York Times, right? Students have all BMC students have free access to Wall Street Journal. But let's get back to the main discussion, which is so then so we talked about two sources of income, and in this example, we have another line item called returns and allowances. That's basically literally, think about it. Returns are when customers, customers can return your products. Either it's a defective or something's not right. So you'll have to subtract it from revenue, right? Because that was returned. You gave them refund. What's allowance? What's allowances? Allowance is a discount given to a channel member. This is not you don't see allowance if you're a retailer. There's no allowance. I mean, you get allowance from the supplier. Allowance is like, let's say I'm Dell, right? So Dell is a computer manufacturer, and then Best Buy is the retailer, and my customer, my client, right? Manufacturer's client. So Dell, and there are not only Best Buy. There's PC Richards and whatever. I don't know other. I don't know of other consumer electronics retailers, but let's say Best Buy. So Best Buy purchases 1,000 units of Model X from Dell, right? And if they buy in large quantity, and if I'm Dell, if they buy like not just 1,000 units, but let's say like 5,000 units, 5,000 computers, or even 10,000 computers. Well, if they buy from us in large quantity, in mass, large quantity, I would normally give, if you buy more than 5,000 units, I give 5% discount or something. Yeah, it's giving discount for something like volume discount, right? Volume discount, large volume, I give discount, right? That's allowance. That's allowance. Okay. Since it is a discount, of course, you will have to subtract it from the gross revenue. Gross revenue. Now, so the allowance is some discount given to channel members. Channel means supply channel, right? Supply channel members. Dell is also a buyer as well. Think about it. Dell buys microchips, parts and components from the parts and components manufacturer. So that's supply chain. Parts and components suppliers supply parts and components to Dell. Dell builds computers. They sell computers to retailers like Best Buy. So the long chain, supply chain. In this supply chain, there is chip maker and like keyboard maker, or all these parts and mouse maker, LED screen, LED screen manufacturer, or, the long chain of supply. So that's called supply chain. And starting from the component and part manufacturer all the way to the final consumer, there's a long chain. But between the parts and components manufacturer and Dell. It's also, there can be allowances. In other words, volume discount, right? So in this case, if we are Dell, there is definitely allowances, right? If we are Best Buy, the retailer, there's no allowance because we are not selling to any channel member. We are selling directly to the consumer, and the consumers we are dealing with is individual consumers, households, maybe could be some company or school buying computers in large quantity. But if they buy large quantity, they might directly approach the manufacturer. So anyway, we can't expect large volume from an individual consumer, right? From an individual. So I entered returns and allowances already as negative, right? The negative numbers on a spreadsheet is expressed by parenthesis or minus sign or by red font, right? And in this spreadsheet, it is negative parenthesis. So I don't need to subtract it because it's already negative. So by simply adding them up, all of them, it will get automatically subtracted. So the result is already here. So I use AutoSum command, AutoSum, and I want you to do. I want everyone to do this with me, right? You must have this file opened in front of you, and you must do it with me at the same time. Oh, I suddenly have a very tight chest. It's really not healthy, the sedentary lifestyle. Sedentary, right? You're sitting all the time. I'm sitting all the time, so this is not a good, healthy lifestyle. So everyone has this file opened in front of you, right? Everyone? Khalid, you have this file opened in front of you? What happened to, I have only, 8 people? I had like 9 people. I lost one. Khalid, that was at 110, so that's not the answer to my question, I guess. So everyone has this file opened in front of you? Let me know. Angel, is it Angel Steven Mendoza? Are you there, Angel? Angel?
Yeah.
Okay, do you have this file in front of you?
I can't see which phone you're showing.
The Excel file. This file.
Yeah, I got it.
You must have this opened in front of you. Antonio, are you there, Antonio?
Yes, I am here.
Yeah, Antonio, do you have this file opened in front of you?
Oh, can you show the Excel file again?
Look, this is.
Okay.
There is only one Excel file in the topics folder. And as I was using this file, you must have this also, opened in front of you. Okay. Khalid, do you have this file in front of you? Khalid, your microphone is on, but okay, why don't you use the microphone? Your microphone is on, but your microphone, you see, I don't know why. It's not working. Okay. Chris Ramirez. Chris, are you there, Chris?
Yes, Professor.
Okay, Chris, do you have this file in front of you? Chris?
Yes, I'm opening it right now.
Okay, Jacob. Jacob, do you have this? Are you there, Jacob? Jacob. I'll have to assume Jacob is not here. Jason, are you there, Jason? Jason?
Yeah, yes,
Yeah, do you have this file opened in front of you?
yes.
Okay, good. Keisha, are you there, Keisha? Keisha? Keisha Anderson? I'll have to assume you're not here. Peter, are you there, Peter?
Yeah, I have
Peter?
it pulled up. I have it pulled up.
Okay, you have that. Okay. Tristan, are you there, Tristan? Tristan Word? Tristan, are you there? I see your microphone. Is your microphone unmuted? Tristan, do you have this file in front of you, Tristan? It suddenly disappeared. Tristan, you have this file in front of you? Okay, good, Tristan. Yosahani. Okay, Tristan. Yosahani, are you there, Yosahani? Yosahani. I'll have to assume Yosahani is not here. Okay, several people have microphone not working. I don't know why. All right. So then, let's do this. Finding that revenue is not a difficult thing, because what all you need to do is sum all of that. And because I said already, returns and allowances is already negative, so if we add them up, it will be automatically subtracted. So all you need to do is use auto sum, right? Because if you use auto sum, it will sum everything in the range, all the data points in that range, in that contiguous range. Okay, hit OK. You got the revenue. And then expenses. When it comes to expenses, there are two sources of expenses: direct expense and indirect expense. Okay, direct expense is the cost of production cost. Okay, why? Direct expense is direct cost, and the reason it's called direct cost is because it changes directly with the production level. Okay, so let's go back to the Dell example. Suppose Dell, in our example, we assumed that the Dell sells this. Dell sells, Model X. Let's say Model X. Model X computer Model X is selling for $300 to the retailer like Best Buy. Okay, that price is called, X factory price. X factory. X factory meaning, price leaving the factory. Okay. Price exiting the factory, right? The price at the point of exiting the factory. X factory. I'm sorry. And we all understand, if X factory price is $300, right? Best Buy, that's the price Best Buy pays. That's the price that the Best Buy pays to Dell. And of course, Best Buy won't sell it. Best Buy is not going to sell it for $300. Best Buy will sell it for at least like $500. But we can, although these days Dell is directly marketing, in other words, selling directly to the end users, right? Consumers, end user consumers. That's called direct marketing, and direct marketing is quite prevalent since the days of the internet, since the coming of the internet. So they have been, Dell was even, starting. Dell, when Dell started, they started with direct marketing. They were selling directly. They took the order online and built a computer and shipped directly to. But now they are in massive production. They sell not they don't do direct marketing only, but they also sell to the big retail outlets. That way, they have bigger market exposure. In the early days of Dell, they had to. They were not very well known, and they had big competitors like IBM. So Hewlett Packard and Compaq. Compaq is now Hewlett Packard, but there was a company called Compaq. But Dell was a smaller company at the time, so they couldn't directly compete with these giant competitors. So they had to do the direct marketing, and through direct marketing they could cut down the middleman's margin, right? They could cut down on middleman's margin, so they could compete. Now, but let's say now let's assume you are Dell, okay? So that means Dell's price is 300. This price is Dell's X factory price, and this is Dell price. But you can tell also if the computer is $300, the production cost of the computer must have been less than $300. Of course, nobody will, if it costs $300 to build a computer, nobody will sell it for $300. So production cost, and production cost, let's say the production cost per unit or unit production cost, right? Oh, come on, my mouse is. Let's say unit production cost is $200. Okay, everyone is following so far. And of course, unit production cost consists of because this is the production cost, then what we need to understand is what goes into the production. What goes into the production of the computer? Can anybody tell me what goes into the production of computer? It doesn't have to be an exact description, but at least you would have a pretty good idea what should be the. Okay, we can talk about the factors of production, right? Factors of production. What are the factors of production? No matter what industry it is, there are three factors of production, right? Everything can fall into factors of production or inputs of production. So if you think about it, regardless of the industry, the inputs are the same. Okay, I don't know if any. There are three inputs, three types of inputs. Can anybody tell me what these three types of inputs are? Anyone? Nobody is. Can anybody tell me what are the inputs? There are three types of inputs. Can anybody tell me what these are? No one? It's almost like just shouting to a hollow cave, huh? I know you guys are there, but some of you are completely detached from the class, or some of you are just some of you are just clueless, or some of you are just not paying attention. Alrighty, so since you are just everyone is just
I think is it raw material?
yeah. That's I said there are three factors. That's just one.
Can I name the other two?
Yeah. Go ahead.
Is it labor and capital as well?
Yes. You got you. And who was this?
Jason Thomas.
Jason Thomas.
Yeah.
So okay, Jason, I'll give you 0.5 for that. Yes, of course, and this is 100 section 1300, fnb 100 section, and 1004. Jason, okay, you got 0.5. Yes, if you think about it, regardless of the industry, as long as it is manufacturing, there are three types of inputs. First is capital. Second, labor. Third, raw material. I'll call that M, material, right? Sometimes raw material is also called, natural resource. Of course, raw material comes from natural resource, right? Of course, things like microchips, I mean, they are not raw, but it's the material, right? In other words, components, parts and components. So instead of calling it chips, parts and components, right? And capital is the physical capital. We're talking about the physical capital, not money capital. What's the definition of capital? Definition of capital is means of production. Means of production. So originally, capital meant something like, machines, right? They are means of production, right? Physical capital, and money, but also it means money capital as well. So there is physical capital, which are like plant and equipment, which are literally means of production. And there is money capital. Money capital is, financial capital. Of course, financial capital can acquire physical capital. Isn't that right? You cannot have physical capital without financial capital. So you must have, plant and equipment, like physical capital, and then labor, right? The manpower, right? And you combine, capital, labor, and material, right? Production equipment, labor, manpower, and parts and components, right? The raw material. Then comes out what? When you combine all of these, right? And then that's the production process. When you combine capital, labor, and wage, it's the production process. And at the end of the production process, you have what? What comes out at the end of the production process? What comes out? Anybody? Isn't it
Final
obvious?
product.
Say that again. Final product. Who said final product?
Antonio.
Antonio. Yes, Antonio. Is final product? Yes, of course. But it's a common sense. But nobody's saying. Antonio, you'll get 0.25. But a better term is finished goods or output. Finished goods or output, right? That means the same thing as final product. But think about it. These are the inputs, right? These are the inputs. Input goes into the production process, and out comes the output. Does that make sense? Right? We use the word inputs, then the matching counterpart is output. Isn't that right? Inputs go into the production process and comes out the output or the finished goods, right? So unit production cost of $200 is the sum of all individual input costs. The capital may be, the cost of unit cost of capital may be $80 for producing one unit, right? Contribution of the physical capital may be $80. Labor may be $100. Parts and components maybe $20, and that's $200, right? Maybe parts and components maybe $80, and physical capital, portion of the physical capital, usage of the physical capital for producing one unit maybe $20, right? The cost of that will be maybe $20. Labor would be the biggest chunk of that. Labor is always the biggest part of the production cost. So think about it. The combination sum of all of these, right, is unit production cost. Okay, and the unit production cost is only literally per unit. So if you produce one unit, it will be $200. But if you produce 10 units, it will have to be $2,000. Isn't that right? If you produce 10,000 units, it will have to be 10,000 units. If you produce 1,000 units, it will be $200,000. Makes sense? If you produce 10,000 units, $2 million. So you can see that there is a so the direct cost changes. So you multiply this by quantity. In other words, units built, quantity produced, or quantity built. Quantity made, or quantity produced, or quantity built. Suppose so that's, so times the quantity built, Okay. This unit cost, right? Unit production cost, $200 times quantity built. That's what? That's the direct cost, right? So you can tell direct cost. Oh my God. So hard. Come on, my mouse is acting up. Direct cost. Okay. Now, if you think about it, so direct cost changes with the production level. You understand? If you produce 0 unit, it will be 0. But then if you produce 1 unit, it's $200. If you produce 10 units, 2,000. 100 units, 20,000. 1,000 units, 200,000. So your direct cost changes with the production level or output level. You understand? It changes with production level or output level. And therefore, it's also called total variable cost. Total variable cost. And total variable cost is the microeconomics terminology for direct cost. And it means variable. Variable means what? It changes, it varies, right? Total of this direct cost changes with the production level or output level. Hence, total variable cost. You understand? The word vary means change, right? It changes with output level. Okay? And in accounting, the same thing is called the CGS, cost of goods sold, right? It's called CGS, cost of goods sold. They mean the same thing. In microeconomics, total variable cost. In accounting, cost of goods sold or CGS. But cost of goods sold, is in semantics. I mean, just to be precise in semantics, it's not the same thing as cost of goods produced, right? I'm gonna come back to that later. But you understand, total variable cost is sum of all the cost, labor, and material, right? And unit production cost is called also average variable cost, right? Per unit production cost, unit cost is called average variable cost. Why? Think about it. Total variable cost is the unit production cost times quantity built, right? And unit means, per unit, right? So you divide it total by quantity. Unit means, dividing total by quantity will give you unit production cost, because of course you will arrive at unit production cost because total is the result of unit production cost times quantity. So if you divide total total production cost by quantity, you will have to get to unit production cost. But think about it. Total divided by quantity is average, isn't it right? Total divided quantity is average. Of course, in our example, it's an industrial product. Each unit cannot have different cost, right? Each unit cannot have different production cost. But by definition, total divided by quantity is average. Isn't that right? Total divided by quantity is average. So it's only right to call, again, another name for unit production cost is also average variable cost, right? It's also called average variable cost. So we have to come to now the realization that total variable cost, that's the direct cost, and it's called direct cost because it changes directly with output level or production level. And of course, then it's called the total variable cost because it means it's varying with the production level, right? And if you divide it by quantity, then it's called average variable cost. So average variable cost is the same thing as per unit production cost. Okay. Now that explains, direct cost. Cost of goods sold is just the accounting's terminology, right? And I'm gonna talk more about that after the break. Now it's 2:11, and um, I can barely project voice, so this is a good time to take a break. So it's 2:11. We're gonna reconvene at 2:21. Okay, reconvene at 2:21. All right. Now stop sharing, and yeah, muting myself. All right, we're back. We're back. Um, so um, we were talking about the direct cost and indirect cost. I mean, first we were talking about the direct cost because, as I said, expenses come from two major sources, right? Expenses come from two major sources. One, direct cost, and two, indirect cost, right? And so as you can see, in the income statement, under the title expenses, right? There is CGS, which is direct cost, and then operating expenses or OPEX, which is indirect cost, right? So as you can see, you have to first spot what are the major line item and what are the minor line items. And of course, CGS is a major line item, right? Because that's what uh, as you can see, directly related to production, right? The costs that are directly related to production, and um, you would expect, the capital, labor, and uh, material, raw material. Yes, but if it is, if you are a manufacturer, that would be the breakdown of the direct cost. But in this is somehow retail business. In retail doesn't produce anything, so retail doesn't have any physical capital, like physical assets, production equipment. Retail doesn't have any plant and equipment. Retail doesn't have any raw material. Retail doesn't. Um, Retail simply, uh, represents its direct cost by the inventory, right? Inventory is, basically their merchandise, right? And basically out of their, so I'm going to get to this later, but CGS is the conclusion of their direct cost. And OPEX, or operating expenses is the conclusion of their uh, indirect cost. And indirect cost is unrelated or uh, indirectly related, I should say. It's not totally unrelated, but it is, indirectly related, or it's unrelated in terms of, production level. Indirect cost is not changing with the production level. So indirect cost is the cost that's not changing with the production level. So indirect cost is relatively constant. Excuse me. Relatively constant, meaning that it's not fixed. Oh, it's not completely fixed, but relatively constant. And it is constant and fixed in terms of, production level, because no matter what the production level is, whether the production level goes up, output level goes up or goes down, indirect cost doesn't change, right? That's why it's called, unrelated to production. Okay, but before we get to that, let's first think about what I said previously, that CGS is not exactly, CGS stands for cost of goods sold, right? Cost of goods sold means, literally, if you sold 1,000 units, right? If you sold 1,000 units, um, and let's put yourself in Dell's, position. Um, put yourself in Dell's place. You are Dell. You're the computer manufacturer, and you have produced 1,000 units of computers, 1,000 units of Model X. And if all 1,000 units are sold, and so the production cost, in other words, total variable cost, right? Total variable cost is 200,000, because we assumed right, unit production cost is $200. So if they produced 1,000 units, if they built 1,000 units, their total variable cost, right, or their direct cost is 200,000, right? The direct cost is 200,000. But that is the if you consider, I mean, if you look at it from the concept like cost of goods sold, that's not yet cost of goods sold. That's just the cost of goods produced. That's just the cost of goods built. Isn't it right? That 200,000 is the cost of goods built, or cost of goods made, cost of goods produced, right? It's not exactly cost of goods sold. If they sold all those 1,000 units, then that's exactly cost of goods sold. And if that's the case, then the cost of goods sold is equal to the cost of goods built. Right? Makes sense? But there's no, not all the time, there's no guarantee that cost of goods built is the cost of goods sold. Sometimes you produce, you produced 1,000 units, but sometimes only 900 units can be sold. You may have 100 units surplus or in excess, right? And that can happen, right? Why? Because we live in a real world. Well, real world, nobody has a perfect foresight. Nobody has a perfect foresight. That means our demand forecast may be inaccurate. Of course, our demand forecast cannot be 100% accurate. It's like only about 90% accurate. I mean, even if it is 90% accurate, it's a high accuracy. So sometimes our demand forecast may overshoot or undershoot the actual demand. Okay, you understand, everyone? So what if? So this can happen if we overshot the actual forecast, overshot the actual demand, we could produce more than. Huh? Someone was saying something? Was somebody saying something? Okay, if you're not speaking to me, please mute your microphone. So this is quite possible, right? Sometimes, you can overproduce or underproduce, right? You can, because your demand forecast overshot the actual demand or undershot the actual demand. And so you overshot, your demand forecast overshot the actual demand. So you're left with, 100 units unsold, right? Which is an excess. But this won't happen in a perfect universe. In a perfect universe, you have a perfect foresight. Your forecast is accurate. You will build exactly as many units as in demand, right? The exact quantity demanded, and there will be no surplus, no shortage, right? There will be no surplus, no shortage. But the reality is not like that. So basically, if we assume a perfect universe, in an ideal universe, cost of goods sold is exactly the cost of goods built, cost of goods made. Okay. But then we can. That's why we use, we equate TVC, total variable cost, with CGS. But again, even if we admit, okay, relax the assumption. I mean, we cannot. The reality is that we are not in a perfect universe, and we can make errors in demand forecast. So even if that's the case, eventually we will sell everything. Why? Think about it. So we sold these, computers for $300. We sold these computers for $300, but we could sell only 900. We could sell only 900 because the demand was only for 900. We have, 100 in surplus or excess capacity, excess quantity produced, right? Then what do? If we could sell only 900 and still 100 is left, 100 units are left, what do? Tell me. If anybody has been following, right? This is quite a common sense thing. The company has, the company has 100 units left unsold, right? Then what would you do? If you have merchandise left unsold, what do?
Lower prices, maybe?
Yeah. And Antonio, was it Antonio?
Yeah.
Can you repeat that?
If you can't sell product, then you would lower the price of the supply.
Yeah. You drop the price, reduce the price, lower the price. And if you lower the price, then it will sell. You can lower it until it sells. But of course, you cannot lower it below 200 because 200 is your production cost, right? You cannot lower it below 200. But if you drop the price from 300 to 290, some will sell. If there is something still left, drop it to 280. It will sell. And still something left, drop to 270, right? Gradually, right? By lowering price, you can sell everything. So then, even in the real world, right? In an imperfect world, yeah, cost of goods sold is equal to cost of goods made, right? Or cost of goods built. Okay, all right. So that makes sense. So we can that way. So Antonio, I'll give you another 0.25 for that answer. Um, so that's why direct cost is, cost of goods sold, as well as total variable cost, which can break down into average variable cost times quantity. Okay, and then, as I said, this income statement is typical of retailer. And our example was, I mean, Dell is a manufacturer, so the direct cost part isn't exactly matching. But if you're a retailer, basically you count or you evaluate your cost of goods sold by the value of the inventory. I'm going to come back to that. And then the second source of cost is indirect cost. And the indirect cost is also called operating expenses, OPEX, operating expenses. And again, this is accounting's terminology, just like CGS is accounting's terminology. In microeconomics, it's called total fixed cost. Total fixed cost. But total fixed cost is not exactly the same thing as OPEX, but it's roughly equivalent. It's not exactly the same, right? And the reason I'm saying it's roughly equivalent is in microeconomics, they are focusing, microeconomics focuses more on the initial investment in this business, right? Now, what is initial investment? Think about it. Dell is a computer manufacturer, right? And any manufacturing, if you think about manufacturing, there's the biggest and most salient difference between the manufacturing and retail is the plant and equipment. Isn't it right? Think about it. Retail doesn't have plant and equipment. In other words, retail doesn't have any production facility. Retail doesn't have factory. Retail doesn't have production equipment. But manufacturing, there can be no manufacturing without production equipment, without factory, right? Without plant, right? So it takes more startup capital. If you think about it, it takes a lot of startup capital, right? For manufacturing, right? It involves construction, right? And it involves, if you build a factory, then if you have built a plant, then it must be, you must put in the production equipment in it, right? So there's a huge startup capital compared to retail. Retail, all you need is you need to rent a space, retail space, isn't it right? And then just merchandise, you finished goods, right? So there's no the initial capital, the startup capital requirement is very low compared to manufacturing, right? Retail startup capital requirement is very low compared to manufacturing. And in manufacturing, of course, you have to have technology. In retail, what technology do you need? I mean, you're not making anything, right? And then, so manufacturing has a huge sunk cost, okay? That initial investment is called sunk cost, right? Even before starting production and selling your first unit, you must invest like, tens of millions of dollars, I mean, the plant will be like 10 million, 20 million, 30 million, even $100 million to build a plant, right? It could be more. It will be more, hundreds of millions of dollars. Could be more. But even if you start small, right? All these, back in 1977, Bill Gates started to build a computer, right? Bill Gates started to build, PC in his father's, garage. Steve Jobs too. He started to build his, Apple computer in, his father's garage. Or, I mean, if you start small, of course, but that's like, hand manually, assembling computers, right? But that cannot be, you have to be, as a manufacturer, you must be on a massive, like mass production. You must produce it on a mass scale, so mass production. Then the plant will cost like tens of millions of dollars, even hundreds of millions of dollars, right? So even the investment you must sink this money, tens of millions of dollars, into this business. That investment is sunk into the business, hence it's called sunk cost, right? Initial investment is called sunk cost. And there is no sunk cost in retail, right? You can easily close out the business, whereas manufacturing is very difficult to close out the business because you have already, until you recover all that sunk cost, you can't close out the business, right? So in microeconomics, the focus is mainly on that sunk cost, and it's called total fixed cost, because sunk cost doesn't change with the right. The initial investment doesn't change with the production level, right? But in accounting, they focus more on operating expenses. So it's slightly different, but the nature, I mean, in the sense that they don't change, they don't depend on they don't change with production level. It's the same thing. All right, we're out of time, so we'll have to call it a day here. Did I talk about the quiz one at the beginning of the? I believe I did. Quiz one is posted already. You gotta check the thing announcements. You must have got the instruction by email. So please, if I haven't talked about it at the beginning, please check the announcements. Okay. Now, so that's it for today. I will see you guys on Wednesday. Okay.
Have a good day, Professor.
All right, have a good
you
day.
too. All right. I will stop sharing, stop recording, and sign out.